Hi everyone, I'm Jeff Ong from Dr. Wealth. I'm here to talk to you about B4R property investing strategy and that how investors are retiring on properties based on this. But first, a disclaimer. Now, what is B4R or BRRRR? Now, that's quite a mouthful, right? That's why I mentioned B4R. Well, first B stands for to buy, preferably below market value, because profit is when you buy and not when you sell. Number two is to refurbish, the first R, to force capital appreciation and to extend, maybe extending the house at the back, loft conversions, which is to convert the attic into a room and add bedrooms en suites, which is a bathroom attached to the room. Now you can see that all these usually is done on houses, and you are unable to add much value onto apartments. Even if you spend $1 million in renovation, you're not likely to add that kind of value. And not all of it is being recognized as well. So number three is rent. You could do single room rents. So if you have 7 bedrooms, you could be renting out 7 separate contracts, and that will give you about 25 to 50% more rental income. It also diversifies your income stream from 7 tenants instead of 1. Sometimes you could do single lets if the area is appropriate. Do note that the layout is different for room rentals versus single lets. But one thing is cash flow must always be positive. If you are taking a mortgage at 75% loan to value ratio, so the cash flow must always, net of all costs, must be always above what you need to service. And if that fails, the more you buy, and if it's cash flow negative, the worse it gets. Okay, so number 4 is refinance. After you have added value, you stabilize the rent and the cash flow starts coming in, you need to get as high an LTV or loan to value ratio as possible, subject to positive cash flow. So when do you stop? You do not, there will always be a buffer of 25% of the net cash flow above the mortgage servicing. You need a buffer because you have to take into account like COVID, another lockdown, tenants lost their jobs, and you have void periods. There are major repairs to do on the roof, leaking and whatsoever. So that's very important. So net rental income must be 125% of mortgage servicing. Number 5 is recycle, which is to extract cash to buy the next house. And that's the only way to grow your property portfolio. Now, buy is a science as well as an art. A lot of it is science, a lot of it is numbers. You need to start from top down, from the country onwards. You need to choose the country that allows you to do mortgage at least 50% loan to value ratio. You'll find that a lot of countries that you invest in as a foreigner is all cash, and none of the local banks are willing to lend you. So that is not on. You need to find a country that is able to lend you as a foreign investor a mortgage. B, you need to be able to buy existing properties, not resale or not new properties. So a lot of countries are no-go as well. Australia does not allow foreigners to buy existing property. So the problem is that you can buy new from the developer, but it's always 20 to 30% price higher, and therefore the first 5 years of the capital appreciation is gone, and the returns are often very low. It's less than half of the returns from buying something that is old. So do not enter into countries that do not welcome foreigners. Taxes must not be prohibitive for foreigners. So you can see that Singapore, for example, has a stamp duty that is 20% for foreigners. So that is very difficult. Already the first 4 years to 5 years of capital appreciation is wiped out. D, some of the examples that countries that are welcoming foreigners. New Zealand is very unique because it allows Singaporeans and Australians only to buy resale properties with no additional tax. UK, US taxes are favorable. You can get a mortgage in that country as well. Now E, this is very important here. You need a rule of law, a strong rule of law, because one day something bad will happen. You always need lawyers to handle, and you may need to evict tenants. So if the country doesn't have a strong rule of law, you worry about possession, whether your title is indeed real. Now, population must be growing at least 0.5% a year, so you can exclude countries like Japan that has a growing population and is actually shrinking. Next, you drill down to the city. You need to ensure that the city salary is growing at least in line with national average or faster. So examples of fast growing cities, Derby, in UK, you have London as well. So population also must be growing. For example, Auckland's population used to be growing at 3 to 4% per year, and that's much faster than Singapore. So the city must have one or more industry growing. For example, London, you have universities, education, tourism, politics, finance. New York, you have universities, tourism, finance as well. Do not buy in small towns where there's only one industry, whether it's mining or social services or a single university town. That will not be advisable. D, to buy near places of employment, ideally walking distance to work. It could be a hospital, university, 5 to 10 minutes walk. If not, and if it's too expensive, then it must be within 5 minutes to a train station or bus stop, and then from there within 30 minutes to the place of work. Now these are must. Okay. Now, drilling down to the suburbs and comparables, you need to see that the suburb has a falling crime rate. On a price per square foot basis, it is cheaper than the surrounding. So I don't usually go for the most expensive suburb. I go for the suburb that's next to the most expensive one. So there's flow over and you get that lift in price. And also in that area, do not buy the most expensive house in the best street. I often buy the cheapest house in the best street. So the price per square foot should ideally be cheaper than the median. So it allows the valuer to uplift the valuation easily. And if you buy something that's well overvalued, it's very difficult to justify a further price increase unless the place that you buy, there are exceptions. It has a special thing going on. For example, in a suburb where you are not allowed to do HMOs or house of multiple occupants, and you are the only one with license to do that, or you have a sea view whereas others don't, then you're willing to pay a little bit more, but not too much, and still never be the most expensive house. Rental analysis, you need to make comparables and make sure that the rents are achievable. Oftentimes, a lot of rents are promised, but actually when you go to the online to check what the rentals are, you notice that they are not what it actually is. It's probably 20 to 30% lower. So then you need to do numbers. You need to do returns on investments. That will give you the net yield after all expenses. Now you find that a lot of cities with very slow or negative growth in rents and capital gains actually have a very high starting yield. So, and many fast growing cities actually have very low yields. Now, so internal rate return actually gives you the full picture because it projects the capital gains and rent growth. And internal rate of return takes into leverage and when you can realistically extract all capital out of it. For example, in year 3, year 5, you could extract capital because of fast capital appreciation and high cash flow. You could actually boost your internal rate of return. So that's very important and is seldom taught in many industries as well. Now, refurbishment, how do you add value to a property? So as I mentioned earlier, usually terraces, semi-detached and bungalows are a lot easier to add because you can get planning to split a big house, for example, 2,000 square foot house into 2 flats, and that's been done before. Or you can get planning to extend the back of the house, add a kitchen, more rooms, so loft conversions and add ensuite rooms. So these are the ways that you can typically raise the value quite drastically. It could be 10 to 20%, even 50 to 100% value increase. Now, choosing a power team is very important. You need to have a project a manager who oftentimes charge about 10% of the project cost. You may have planning consultants to help you get that planning that you need, lettings manager. So for beginners, I would prefer that you do not manage your own project yourself because I think project managers often have that special relationship with contractors, and because of repeated businesses coming from them, it's easier to manage the workers. So how do you pick your project manager? Usually from referral from the sourcing agents, or you can check online for reviews, and there are many other tricks as well. For more, one thing you need to note is that the more refurbishment, the more potential to force capital appreciation, but also there's a higher risk of error. In general, for every dollar that you put into the refurb, you should try to generate at more than $1 worth of valuation increase. So if you have spent $100,000 in your refurbishment, it will lift your value by at least, ideally, $200,000 to $300,000, 3 times of your refurb, and that would be the ideal. There is also another way that if you refurb, the rental income will have grown. For example, if you spend $100,000, the rental income will have grown by $30,000 because of the refurbishment. You know that your return on refurbishment is actually 30%. Now, rent. What is the profile of tenants you wish to rent to? Generally, I prefer white-collar workers because I feel that they are less likely to lose their job. They will get a promotion faster, pay rises, and also white-collar areas are likely to fetch a better resale price because a lot of families will want to shift there because of good primary schools. Now, there are some landlords that like blue-collar areas, which is not bad. You could have people who are more senior, who work in car workshops, and they got generally good, stable income, and you know that could work as well, and the use could be high. Social housing is very big. There are people who are unable to take care of themselves, and the government pay your rent directly. Elderly housing is booming in most developed countries, including Singapore, but you require specialist managers to take care of it. What type of lettings manager should you choose? I prefer to choose a local one. So not some agency that controls the entire country. You want someone that specializes in the area. Why? Because most of the time you can contact the owner of the lettings firm immediately, directly, and you can tell them the problems and it can be resolved. You can't get that with nationwide lettings agencies. How do you estimate the rents? There's another trick. You can go to the website to look for the asking rent, or another way is to call the agent twice. Once to pretend as a landlord, you probably get a very high estimated rent, and the second time call back to pretend to be a potential tenant, and you get much lower rent, and the truth is somewhere in between. Okay, now in first world countries, background checks on tenants are very strict. They look at your rental income, your salaries, not your rental income, but your salaries, your pay slips, your employment letters, whether your credit score, whether you have committed any crime. So that is very important. So to prevent eviction, the first thing is to do very thorough background checks. And so the eviction process in many first world countries, for example like UK, is a lot easier than many other countries where it could take 6 months to a year to evict somebody. So in first world countries, for example in UK, your deposits are kept in an escrow account by a national agency. So should you contact the tenant or leave it to the agent? Now, I prefer to have the tenant's contacts because it keeps the agent more honest. I'm not saying that agents are by and large, most of them are honest and doing a good job, but you want to know that you have the direct contact the tenant in case there are large repairs that are being done, and you want to check on the tenant whether the job indeed has been done. And also sometimes when the tenant continues to already stay there, but in very rare cases, agents do not report that the tenants have already been there and report it vacant, so you do not get the rental income. Now, hopefully that doesn't happen to you. So refinancing structure, very important. Many people do not know that they can buy properties under limited companies. Even in Singapore, you could do that for commercial properties. Now, very important is that if you joint venture with somebody, more than one person, you should put it under a limited company. Bear in mind, I'm not a tax advisor, but this is what I would do because it protects you against death, one of your partners going dying, bankruptcy, divorces, and all these are more protected under a company. And even a lot of people have this misconception that if you have very little income, you can't afford to buy a property. That's not true. If you have very little money, let's say 30 to 40K, you can band together with 5-6 people, and if you have enough knowledge, you could come out with very little money, 20,000, and then you lead the JV deal and get some sweat equity for doing all the work, sourcing it and all that. So there are a lot of people with money, but no time and no knowledge. So if you have knowledge, you can find people like that, and then you do lead the JV. So you need to find a suitable mortgage broker that meets your needs, someone that appeals, that caters especially to foreign investors, and also know how to do it under a limited company. So sometimes you may not be able to raise enough money. You could do a bridging finance before you do refurbishment. So that could be quite costly as well. It could be as much as 0.6% to 1% a month. But you got to get it done quickly and then do the refurbishment, then get a proper mortgage to replace the bridging finance. You need to look at what valuers look for. As I mentioned earlier, try to buy below median on a per square foot basis. So that's refinancing. Now finally, you need to achieve 10 properties in 10 years. Extract as much as you can from the properties by lifting the value and yet maintaining positive cash flow. So you take the money and buy your next property. Do not buy everything in one city. Spread out among a few cities, but do not over diversify. You need to have power teams in that city as well. So when do you stop? When you hit 10 to 15 properties, you might decide that your knowledge is good enough to be a JV leader and earn some sweat equity and help others get on board. That could be one, and you continue to expand your portfolio. Some people may decide to start selling their properties one by one after 10 years, because a holding period of a property is about 10 years. Thereafter, it may have doubled in value. So you could sell one property a year as a bonus as you pare down your loans. And this is an example. Most people have a misconception that by owning 1 or 2 properties is enough to retire. As you can see, after 10 years, they may have gone up by 7% a year, and it's still not enough. It's barely 860,000 each, which you need to sell away one property to pay down the loan of the other, and then you are left with one property that you live in and there's no income. So the ideal way is to do the B4R strategy, where you start with one and then you have a capital gains and positive cash flow. You buy the next one, and then you move on to a couple of years later, refinance and buy more. At the end of 10 years, you could expand it. So all these can be done safely if you have capital appreciation and, again, very strong, good cash flow. And I've come to the end of my presentation. I hope you have learned a lot, and I will see you in the webinars where I'll review